Hey, this is Matt from InvestiQuant. Today is Friday, October 9th, 2020. And yesterday we saw the markets gap up and consolidate higher the majority of the day. We ended up closing at the highs of the week in all of the markets. And in the overnight session, we have continued to push a little bit higher. So on this Friday morning, we appear to be opening at the highs of the week after a strong close. I figured that'd be something interesting to look at. So let's do that here in Discover. I'm going to look at all four instruments in Discover. We're going to use the setup intraday open and long. So this is going to be getting long at the open of regular trading hours and exit at the close of regular trading hours. For the opening filters, I'm going to use an opening filter of open above the highest high of the prior 5 days. That's found here in the opening area section, and that is going to put us above the highs that are made within the regular trading hours throughout the week. So we'll be opening at a new high for the week. And then I'm going to go into price patterns and say that yesterday closed at a 5-day high. So that means we closed at the highest price of the week yesterday. And then I'm going to go into indicators, put us in a bullish environment above a 10, above a 200. And lastly, I am going to say specifically that it is Friday, so we can make this based upon these prior 5 days, based upon the week that we are seeing here. So this is going to look at opening above the highs of the week after a strong close in a bullish market on Friday. Let me hit view results and we'll take a look. And here we go. So these are the results of going long at the open of regular trading hours, 9:30 a.m. Eastern Time, exiting at the close, 4:15 p.m. Eastern Time, when the prior day closed at a 5-day high, and then on the next morning, being a Friday morning, you're opening above the highest high of the prior 5 days. So you're opening above recent highs. This is taking place in a bullish environment, defined as above a 10 and 200-day moving average. Historically, the S&P has 74 samples, NASDAQ 85 samples, the Dow 85 samples, and the Russell 51 samples. And if we look at the win rates, all four of these are at least a little bit weak, with Russell being pretty neutral. S&P coming in at 42%, so that's a little weak. The NASDAQ 43.5%, so that's a little weak. The Dow is the weakest at 39%, and then the Russell is more neutral at 49%. If we look at the average win, average loss, looks like the average loss just a little bit bigger than the average win here for the S&P. On the NASDAQ, the average loss is larger than the average win. The Dow is the one with the weakest win rate, but its average loss is not larger than its average win. The Russell, with the most neutral win rate, also has a larger average loss compared to the average win. And lastly, let's take a quick look at the results distribution. I've got the S&P that is loaded here already. I'll click there, and you can see the results distribution of this test. The way this results distribution is laid out, you've got the sample size or the trade count on the vertical axis, and the P&L in dollars based upon trading one contract of the ES on the horizontal axis, zero line right here in the center, and one standard deviation from the average trade. The average trade is just a little bit left of zero here. The one standard deviation area is highlighted in blue. So the taller the bars, the more frequently that result has happened, and then the farther to the extremes, the larger the move has been historically. The more normal moves based upon this are falling within the one standard deviation area. And you can see the most common result here is a small losing day. But as you start to go out, you do see there's quite a few more bigger moves to the downside on the losing side here compared to the winning side. And just for reference, one standard deviation here on the upside is coming in around this plus $400 bar. So this is plus $400, or that would be plus 8 points in the S&P. That would be comparable to this bar right here. And they're both about the same size. So the highlighting here doesn't make it obvious that these bars right here next to it they're still around the one standard deviation area, but they would be comparable. This is minus 10 points, minus 12 points. These two bars would be comparable to these two bars as far as size goes. So you can kind of see there are taller bars to the left here on the downside. So some bigger moves to the downside historically. So hopefully you found that helpful. Good luck today. We'll see you next time.